Katekbok, and welcome back to our YouTube channel. This has been your teacher, Mr. Malang Bernabe. I would like to welcome you another for video lessons that we are going to discuss for today. So there are different kinds of types of accounts that we need to understand in our fundamentals of accounting, but we're going to go into what are the basic elements of accounting. So there are only 5 basic elements of accounting class. So number 1 is asset, number 2 is liabilities, then number 3 is equity, number 4 is revenue, and number 5 is expenses. These 5 basic elements of accounting will always come and go. So remember this word, okay? So there are 5: asset, liabilities, equity, revenue, and expenses. So in the fundamentals of accounting include recording keeping, which is the primary function of accounting. A business must use standard forms of storing and retaining information so it can be retrieved when the need for it arises. Through an accurate storage of recording, it is very essential for all transaction-related purposes. So, what is accounting and fundamental of accounting? According to definition, accounting is the language of business. It is an information and measurement system that identifies, records, and communicates relevant, reliable, and comparable information about business activity in economic terms. There are 3 major accounting activities are identifying. We have recording, communicating, and let's going to discuss the types of accounts. So again, as I said, there are 5. So let's start with the assets. So assets, again, based on my previous video, we have defined assets as tangible and intangible items that company owns that have a value. Example are the cash, computer system, patents, and copyright or whatever. So liabilities also is defined as money that company owes to other. It might be an individual or company. Example of these are mortgage, the vehicle, the different loans, and the different accounts payable. So equity is that portion of the total asset that the owners or stockholders of the company fully own have paid for outright. So that's equity. Revenue or income is money that company earns from its sales of products or services that company has been offered. And interest of dividends earned from marketable securities. So that is revenue. While expenses are money that that company spend to produce the goods or services that is being sold. Example are these office supplies, utilities, and advertising. So that is example of expenses. So again, according to definition, assets can be defined as an object or entries, whether tangible or intangible, that company owns that have economic value. While tangible assets are physical entities that the business owns, such as land, buildings, vehicles, equipments, and inventory. While intangible assets are things that represent money or value. Example are accounts receivable, patents, contracts, the certificate of deposits, and so on and so forth. A company asset are also grouped according to either their lifespan or liquidity. The speed of which they can be converted into cash. Current assets are items that are completely consumed. Excuse me. Sold or converted into cash in 12 months or less. Example are current assets that include accounts receivable and prepared expenses. Fixed assets or non-current assets are tangible assets with a lifespan of at least 1 year and usually longer. Fixed asset might include machinery, buildings, and vehicle, fixed assets are typically not very liquid. Because of their higher cost and longevity, assets are not expensed but depreciated or written off over a number of years according to one of our several depreciation schedule. While liabilities are those debts of financial obligation of a business, the money that the business owes to another from individual or company or lending companies. Liabilities are classified as long or current term liabilities. Current liabilities are debts that are paid in 12 months or less and consist of mainly of monthly operating debts. Example of current liabilities may include accounts payable and customers' deposits. Current liabilities are usually paid with current assets. Example, the money if the company checking account. A company's working capital is difference between its current asset and current liabilities. Managing short-term debt of having adequate working capital is a vital to a company's long-term success. Long-term liabilities or non-current liabilities are typically mortgages or loans used to purchase or maintain fixed assets and are paid off in years instead of months. While equity is of utmost importance to the business owner because it is the owner's financial share or company or that portion of the total asset of the company that the owner or shareholders fully owns. Equity may be in assets such as buildings and equipments or cash. Equity is also referred as net worth. Okay? So the three accounts type we thus far discussed, asset, liabilities, and equities, are the three elements of the accounting equation. Their relationship is shown on the balance sheet using the accounting operations. That's why it is called always asset equals to liabilities plus equity. Writing the accounting equation in a bit differently makes easier to understand the concept of owner's equity. While equity is equals to asset minus liabilities. Owner or shareholders' equity is what is left over when the value of company total's liabilities are subtracted from the value of its assets. A decrease on its liabilities increases equity, but an increase in liability decreases its equity. Likewise, increasing asset increase equity, but decrease in asset lowers its equity. Example, if we have purchased 30,000 vehicles with a 25,000 loans and 5,000 in cash, we acquire an asset of 30,000 but have only paid 5,000 for equity. We see this using either version of the accounting equation that asset 30,000 equals liabilities 25,000 plus equity of 5,000. Or it might be equity is 5,000 equals asset 30,000 minus liability of 12,000. So the same, it will be equal in balance. Now let's draw our attention to the three types of equity accounts discussed below that will meet the needs of many small business. The types of equity accounts, they are the three types of equity accounts that need to know about. These accounts have different names depending on their company structure. So we list the different account names in the charts below. So we have number one, the contribution or money invested. There are times when company owners must invest their own money in the company. If maybe startup capital or later infusion of cash. When this occurs, a capital or investment account is credited. Distribution or draw, money withdrawn. If the business is profitable, the owners often want to some of the profit returned to them. Of course, To track this activity, a draw or a distribution account is debited. This is the only equity account, non-contra, that receive debits. Okay? So, accumulation from prior years. To track the company net income as an accumulates over the year, retained earnings or owner's equity is credited. On the first day of the fiscal year, most accounting programs automatically credit this account with the previous year's net income. So, income or revenue. So, income is money the business earned from the selling of product or services, or from interest and dividends on marketable securities. Other names for income are revenue, gross income, turnover, and other term is top line. Net income class is revenue less expenses. So that is how you're going to get the net income. It is from revenue minus expenses equals to net income. Other names of net income are profit, net profit, or that's sometimes called the bottom line. Income is realized differently depending on the accounting method used. When business use the accrual basis accounting method, the revenue is counted as soon as an invoice entered into the accounting system. So if there is no invoice, no recording. If the cash-based accounting method is used, the revenue is not realized until the invoice is paid. That's correct. Income accounts are temporary or nominal accounts because their balance is reset to zero at the beginning of each new accounting period, usually a fiscal year. Most accounting programs perform their tasks automatically. So while expenses are expenditures, often monthly, that allow a company to operate. Example of the expenses are office supplies, utilities, the rentals, entertainment, what are these various travel expense. So that is expenses of the company. Like revenue accounts, expenses accounts are temporary accounts that collect data from one accounting period and reset to zero at the beginning of the next accounting period. Most accounting programs perform their task automatically. A unique type of expense account, depreciation expense, is used when purchasing fixed asset, costly items such as vehicles, equipment, and computer systems are not expense but are depreciated or written off over the life expenses of expectancy of the item. So another unique account is accumulated depreciation. This is a contra account. Accumulated depreciation is used to offset the asset account for the item. Depreciation can be very complicated, so we recommend seeing your account for help with depreciation of assets. So those are the 5 basic elements of accounting. So the asset, the liabilities, equity, revenue, and expense. So I hope you have learned something, and that's it for today, and I hope I'll see you on my next video. For the meantime, again, please do not forget to subscribe our YouTube channel, presentation.techbook.tv. Please click that notification bell so that in every now and then that I have a new video for accounting lesson, you will be notified immediately. So thank you for being patient in listening to me. Thank you very much. Have a great day ahead. And this has been your teacher, Mr. Malang Bernabe, will now signing off. Goodbye, class.